welcome to my channel. I'm Dr. Romano. Today's topic is going to be why smaller hedge funds outperform larger hedge funds. Before we continue the video, please remember to subscribe so you get my future videos. And of course, remember to do thumbs up so that my videos are included in the search engine so that other people could watch my videos as well. And of course, to help me out, since I give you free information and I answer your questions because I'm here for you, please remember to share my video with at least 5 people to help me out. I would really appreciate that. And lastly, send me questions to the live chat so that I can make future videos just for you to answer your questions. I want to thank you so much for watching. I'm going to share my experiences and my research based on what I've learned and come across during my Ph.D. research and as I researched my first and second book. This video is for beginners, for advanced, for all people who love hedge funds, as I do. So to begin, as a trader, I'm going to explain why, so what we're talking about if you don't know what a hedge fund is. A hedge fund is a financial trader, a person like you and me, who trades on a particular market. That could be the equities market, that could be a currency market, commodities, whatever it is. Your strategy could be a long-term strategy that it's months and years that you're in a position. And other strategies, it's seconds or days or hours that you're in those positions. Now, one of the reasons why my research, so when a PhD student and a researcher conducts research, they have to have an unbiased opinion. And what that means is they're not looking for only one side, because there's plenty of research out there. But basically, as those people who are traders, and let's say you're a day trader and you're trading on some platform, or you're a financial trader in an investment bank or mutual fund, etc., or you could be a trader at a hedge fund. Now, the issue concerns is being able to be nimble. All right. And so larger hedge funds, larger traders with larger portfolios, they're not able to be so nimble because when they pull out of a trade, it goes down the market or it goes up depending on what side they are on. For example, one of the world's wealthiest traders, that's Warren Buffett, he trades a traditional investment approach. What does that mean? It means that he will be in a particular stock or whatever company, whatever you want to call it, for years or even months. Now, because his positions are so large, he has multiple traders getting him into those positions and getting him out of those positions so that nobody knows about it. But usually when it's over, everyone knows about it. However, the people at the investment banks where he chooses to have those positions. And so when he enters a position, the particular asset will go up or down depending on what he's planning on, just because his name and who he is. And as well as a lot of leaks that come about from investment banks and other companies. Maybe he's dealing with hedge funds, who knows what he's doing today. But I remember when I was working for an investment bank, it was a secret, and he was basically entering in a particular company by buying shares of that company. And the traders at the investment bank, their goal was to get the cheapest price for him, but they also had to make money. And so that plays a role in how big positions are. It affects them. And so it's a very complicated process. Now, for those of us who are interested in investing in hedge funds, your job should be to get, if you invest in any product or investment, your main focus is to get the best return with the lowest risk. For example, if you're building homes, You get the cheapest materials to build it, the cheapest people to do the actual construction, the cheapest everything to make a profit. And then of course you have to sell it for, the highest amount. And that all plays a role in your profits and your risk as well. Now, when we talk about hedge funds, that's a little different. A hedge fund is someone who's trading on the markets, as I mentioned, and they're placing trades. They could have multiple trades on different indices or different, whatever they're trading. Investments, underlying investments is the correct term. But when you talk about how big those trades are is where it becomes a little complicated. Because if their trades are very large, as I mentioned about Warren Buffett, when he enters or exits a investment, everybody knows about it, and the markets are affected, that particular investment. So that also happens when a large hedge fund trader enters a particular investment and exits an investment. No matter how secret it is, there will always be leaks. And that's just how it is. And so a hedge fund trader has a prime broker, such as, I can't say the big bank's names, but an investment bank. The larger the hedge fund, it's harder to keep those secrets because people talk. They may be talking amongst each other between the prime brokers, what's going on with this hedge fund, and that hedge fund has that amount of billions in that company, etc. It's just talk. So that's why, that's one of the reasons why larger hedge funds, it's hard to keep a secret what their portfolio consists of, as well as the people who do the auditing of the hedge fund. That has to be a separate entity, such as an audit company, accounting company, whatever it is, that's not associated with the hedge fund. Remember, the legal aspect requires it to be an independent outsourced company who does the auditing. Now, the people that also work on that auditing team, they can't keep their mouth shut either, right? It's only logical. Yeah, they're supposed to keep their mouth shut because they probably signed a confidentiality agreement with the audit company that they work for. But you know what? People always talk. And so they know what are the underlying assets of that particular hedge fund, and the kind of the snapshot of that big hedge fund. Then the other question is the accountant that is associated with the hedge fund. Now remember, it also has to be an independent accounting company that's not owned by the hedge fund. And so it's called outsourcing, and it's called independent. And that accounting company also has people that work there. And they also know what the positions are at that particular hedge fund. So again, human beings are hard to keep quiet, and so that's another aspect of why larger hedge funds are not able to keep everything kind of a secret, to be nimble, because their positions are so large that everyone's going to talk about it, that they have $50 million in that particular, they're exiting, or whatever it is, $100 million, whatever it is, or even $200 million in a particular trade if they're worth, if the hedge fund is billions, like probably one of the large top 10 hedge funds, they're in the billions, and so that's one aspect. Keeping things a secret is a big issue. Now, whereas the smaller hedge funds, they're able to get in and out of those trades without pretty much anyone knowing. The audit company, the accounting company is going to really talk because the positions are so small. But when you get those huge trades, everybody wants to talk about them. And I remember when I worked for the investment bank, Warren Buffett was basically entering a particular company. In other words, he was buying shares of that company. A relative of mine was just chit-chatting about it, talking about it with his family, and somehow it trickled down to me. It was actually in the newspaper after it happened Try to keep the secret as best as possible when it's actually happening is the goal of the company. But since big companies have so many people that work there, we're only human, and just because people sign confidentiality agreements, that doesn't mean anything. Now, the second aspect of why smaller hedge funds outperform larger hedge funds is the trade size, as I mentioned previous. So if you want to be a day trader, anyone could be a trader in any capacity. You just need to have a trading platform. If you watch TV commercials, you'll know exactly what a trading platform is. I can't give the name. Basically, they provide the services for you to trade with all the software, etc. And what you'll notice is that when you start placing trades, a trade is that you are going to put money into a particular asset. That's what a trade is, or a position. A position is basically the amount of money that you have in that particular company. And so when I say positions, that's what I mean. Now, you have to remember, so when you start day trading, you're going to do paper trade first. Paper trade is fake trading, basically. It's all simulation, but you are actually entering a company just as you would, but there's no money. It's just, a simulation. It's a great way to start. In other videos, I'll teach you how to trade and how to manage risk. Because I had to, once I completed my Ph.D. research, I had to test out my strategy and my theory. And so the best way to do that is to trade options on the option market. I'll talk about that in other videos, not this video. And that's why I ask you to subscribe to my videos so that you get my future videos or, other videos. And please remember, of course, you have to share my videos with at least 5 people so that your friends and people that you don't know are able to see my information. And also the thumbs up is really important because that will help my videos be included in the search engine. Of course, because I'm here for you, send me questions and I'll make future videos. To continue the video about why smaller hedge funds outperform larger hedge funds is, as I mentioned, when you're trading, let's say you're a day trader and you want to get into or out of a position, it's very easy for you because you don't have billions of dollars worth of capital. You may only have thousands worth of capital, or million, under $1 million, or whatever it is, whatever the possibility is for you to come up with that capital. And so that's why it's so easy as a smaller hedge fund to get in and out of positions, and it's called being nimble. All right, and that's a part of also managing risk. As those of you who are traders, you know that it's all about managing your losing trades. Your winning trades are winning. That's it. You don't have to worry about them. And part of getting out of those trades is to be really fast about it, and you want to get the best price. And so when you're dealing with like 20, 50, 100 million on one particular trade, that's very hard to get in and out. And so whereas the little traders, when you're dealing with smaller trades, it's a lot easier to get in and out. And so my PhD research, now I want to explain where I got my research, what I'm actually saying, if it's true or not, because anyone can say whatever they want to say. But when a PhD student is doing their research, so you could either do a lot of coursework for 4 years or 5 years, you write a dissertation, which is 100, 200 pages. But I didn't do that. I got the privilege, and it's very rare, that because I have 2 MBA specializations, I took so many classes that they couldn't really offer me any more classes, right? So I got a lot of credits towards the PhD. And that allowed me to do research-based. So yes, I took the courses, the necessary courses, but most of them I got waived because I already took it at the MBA level. And so what you want to focus on when you do get a PhD, and I'm going to make a video on, the best way to do it. You have to say to yourself, what is a PhD graduate? That is a person who has a great specialization in a particular discipline, a particular area of that discipline. So just because you have a PhD in psychology, let's say, well, there is a lot of areas of psychology that you need to, narrow it down. So let's say that you want to understand the psychology on college students between 17 and 20. That's what you would study, and that's what a PhD is. In my case, I'm a doctor of financial management and leadership and applied decision science. And my specialization, all of my research is about hedge fund selection and how to manage a hedge fund portfolio. Because I could tell you in another video why I did that. I think I have created a video on that. But so when I was creating research, I was, writing research. I was researching information and writing about it. There's a lot of requirements that research has to be. It has to be, one, peer-reviewed by people in the industry. It has to be written by a PhD. And it also has to be within a certain amount of years based on the university, what they require, because it can't be old data. Now, there are certain PhD students that have no data. For example, in I think it was the 50s or 60s, there was a psychologist, a guy that wanted to become a psychologist, and his name was McKinsey. And we know that as the McKinsey study in psychology. He was a person that had to gather his own information. You see, back then we didn't have computers like we have today and internet, where most of the stuff that we do is recorded. And people are doing a lot of research based on that research. Back in the 50s and 60s, McKinsey had to actually interview each person, a population. You need a certain amount of people that aren't somehow connected. So when I completed my PhD, I had to use a certain amount of data that was already written about. Because if you want to finish your PhD in a certain amount of time, you have no choice. I was not going to interview thousands of hedge funds, even though that I did speak to probably under 100 hedge funds directly to know what was going on, what's their issues, what needs to be improved, etc. But that was just the gist of it. To dig deeper, I had to actually find PhD scholarly written research within a certain amount of years. So when I say something, it's coming from that research, not because I'm just talking out of my what. No. Whatever I say on YouTube is based on what I've studied. It has nothing to do if you go to Harvard or you go to Long Island University, where I went for my undergraduate, or where I went for my PhD and MBA was Walden. At the time, it was between America and Europe. I was living there and living here, and so I was able to do the research pretty much on the computer, as long as I had an internet connection. For those of you who are thinking about doing that type of schooling, it's a lot of work. I'll tell you right now, it's a lot easier to listen to a professor speak and take notes and pass a test if you have the good short-term memory. But in my case, I didn't have that possibility. I knew that listening to a professor and doing, the notes, it wasn't going to give me the specialization that I needed. So I needed to find a school that I could do a lot of research. And I pretty much written over 900 pages of research, actually around 8 plus my dissertation, 200 pages. It was a lot. That is how I became the specialist of a hedge fund selection. There's no major that's going to give you that. There's no going to school and taking a course on hedge fund selection. It's really only going to teach you definition. Because remember, when you take a course, that's what you're learning, is definition. No, I had to come up with my own theory. I disproved the previous theories out there. All about managing risk is using certain risk measures. And those risk measures is what people use in the industry. And so you have to remember, just because people are using that in the industry, it doesn't give you value. And so to get back, that's the reason, so that's where my information is coming from. So based on my information as to why small hedge funds outperform larger hedge funds, it is because there's something that happens at AUM. AUM is assets under management. And once the hedge fund gets up to about $350 million worth of assets, AUM, the trading size becomes pretty big. And once they hit that level, it becomes harder for that trader to get in and out of their positions. It also becomes harder to keep things secret, because when you place small trades, nobody really cares about them. But when people see big trades, they talk about it. That's just how it is in the world, okay? I don't want to hear you tell me, oh, it's not like that. We're human, and that's how it is. And so when I worked for the investment bank, I knew what was going on because I was working for the trading floor. And when someone really big used to place a trade, everyone knew about it. It's not that, just because you sign an agreement, it doesn't mean people are going to be secret about it. Now, as long as they don't go to the media or they try to profit on that privately, then it's an issue. That's called insider trading. And so let's say that you have a portfolio of hedge funds. Since I'm a doctor of hedge fund selection, that's what my specialty is to have a portfolio of hedge funds with about 7 to 10 hedge funds that I've personally selected. And it's creating returns, and so the portfolio has to do a minimum return per year, etc. Now, I don't use the traditional method of risk management because I disproved that with all of my data that was conducted. But when you try to tell that to a portfolio manager at an investment bank, they'll try to fight with you because they think that they have 20 years experience. That's something important. It's an ego trip that they have 20 years experience. You have to question to them and to yourself, what have they done over 20 years to improve the investment approach for risk management for a portfolio? And the question is nothing. Because when you work for a company, are you allowed to change things? No, you're not. You're an employee. Yes, you're a manager. And what do managers do and directors? They manage people. So that's the only thing they're changing. They're not changing the actual principles and the fundamental strategies of the company, because are they willing to take that risk as a human, as an employee? No. An entrepreneur is willing to take that risk. That's why the hedge funds have become who they are. Those women and guys who go on their own and start trading and start to perfect their strategy are the ones that tweak their strategy, their risk management approach, to become better and to minimize risk. So they're not the typical trader at an investment bank where they're really not allowed to do any of that. They have risk management that sits on top of them in a way, in another group, and kind of comes over to them and tells them, like a little boy and little girl, okay, you're overexposed. What are you going to do to get out of this? This is what you need to do. You need to buy puts and calls, etc., and hedge your positions. That's why today the money, the capital it's being poured into hedge funds. And even investment banks today, as of the collapse of 08 and 09, a couple of years afterwards, they realized that their approach to trading was very elementary compared to hedge funds. Remember, if you're a hedge fund trader, you have to be really good at what you do. If you're not good at what you do, you will not survive. So simple. It's like being in the real estate market. If you're not a shark, you won't survive in that market. If you're not the one that's a go-getter to get those new deals and to sell it and to work 7 days a week, you're never gonna make it in real estate. So simple. So in the hedge fund industry, if you're not the type that's gonna think about every little aspect and have that ability to your investment approach, you're not gonna do well. Now, there is an exception. And so you could be a mediocre hedge fund trader, but you could have really good contacts to find capital. And what I noticed, because of part of my research was using hedge fund databases, that's kind of where a lot of hedge funds are listed. So a hedge fund, once they are a hedge fund and they're legally able to raise capital, they usually subscribe to hedge fund databases. Usually it's free, but for investors, they have to pay a yearly subscription. It could be $14,000, it could be $18,000. It just depends what company that you're using. And unfortunately, there's no company that has all the hedge funds in the world listed with them. And it's a very tedious, basically like a needle in a haystack trying to find a really good hedge fund. Now, just because the hedge fund has a lot of capital doesn't mean anything. You have to look at their returns and how they manage their risk. There's more to it, and I'll get into that in other videos. That's why I tell you subscribe to my videos. To continue the conversation about the big hedge funds and little hedge funds, so once they get up to that particular invisible threshold around 350 million, you have to understand the strategy and the markets that they're trading in. They have to be very liquid markets, and if they're not, that's where it becomes an issue. So if they're in the equities market, that's one of the biggest markets in the world, and if they're using a simple strategy like long or short equity, they may not have an issue, but they may have an issue. It just depends on the strategy that they're using. And unfortunately, because everything is very private and that's a mom and pop business, they're not going to tell you their actual strategy, remember. And the laws should protect that trader from doing so. Because if everyone knows their strategy, then they don't have an edge. What is the edge? An ability to create returns and to be private about it, as I mentioned. So larger hedge funds really don't have that edge, whereas little hedge funds do because things are private. When you're approaching the threshold of AUM of 350 million or 300 million, around between that area, you have to start to analyze that particular fund. Yes, you could ask them what strategy they're using. They list it on their information. But you have to remember, there was one hedge fund manager that I had sat down with. He was very nice to me. A friend of mine introduced him to me. And he told me that he was trading backwardation on oil futures. And he said it in such a way that it sounded so sophisticated. And I was like, wow, what is he really doing? It's incredible. I want to learn how to do that. Well, that's what he tells the clients. But in actuality, he's basically trading options, a simple option strategy, either predicting or betting, they call it. I say predictions, that the market's going to go up or down. If you buy, a put to call, you're basing it based on where you think the market's going to go. And it was a simple strategy, but what he tells his clients is two different things. And what he wrote in his brochures was the actual sophisticated terminology, that people love to hear with all the definition and fancy words. But in actuality, he was a options trader, and he was focused on oil. And so even though that you want to ask a trader, what's the strategy, etc., you're not going to know. So you're not going to know what actual assets they're investing in, and you shouldn't know. That's private information. It should be private. You're not going to know what actual strategy they're using. You're going to know a basic gist of it, And you're going to know kind of the markets, like it's equity markets or it's commodities or a currency market. You're going to know that, but that's pretty much it. And so it's up to you to do your research and to follow them and to understand what their ability is to manage risk. All right, so it's all about managing risk. And as a trader, and I have, there's so many people I know as traders, that's the key, is to manage risk. And people in the industry, they understand that as well, but unfortunately, in the industry, they've been managing the risk the same way for years now, decades. And after 08 and 09, it turned out to be a disaster. Because if you have the most sophisticated students from the best universities, so smart, how did all the banks, only a handful left at that time, all go out of business? They didn't go out of business officially, but they did go out of business if it wasn't for the government to step in and to lend them money. And so that whole methodology had to change. And it has been changing, but it's still, people are very stubborn to change. And people that have 20 years experience, as directors at the best investment banks, they now move to the hedge fund industry because that's where they're getting the jobs and they're making the money now. Because there is an imaginary age limit. Once you hit mid-40s, you kind of dwindle away from working in the investment banking industry. Just because once you get up to that age, you're going to move up the ladder and there's less positions as directors. So you're competing with a lot of people. And then, so at a certain point, you just give up. Some people go in the hedge fund industry and they start managing as a portfolio manager. They would work for a funds of funds. So that's what I am. I'm a doctor of a funds of funds, how to manage the risk of a funds of funds and how to select a hedge fund, how to deselect a hedge fund, etc. But what the problem is that they're using the same methodology that they have learned over 20 years at the investment bank. And so that's the problem in the industry. Now, so if I'm explaining, and I know that there is an issue with a hedge fund that's above about 300 million, and their returns are going to get watered down because their positions are too big, then why are the hedge funds getting bigger than that? It's still happening, right? And so investors, big time investors, talking about endowments, universities, hospitals, huge organizations, investment banks, they're still investing in those hedge funds and they're just getting bigger and bigger and bigger. And then the top 10 hedge funds are worth billions. I'm talking about, I don't know what that number is today because it changes, but you have to say to yourself, why are they still getting bigger if you know that the returns are going to get watered down? Isn't it better to have thousands of traders trading your capital in a market as opposed to the hedge fund that you invest in like one or two? I mean, it's logical that the markets became so unstable in the 1990s and the early part of under 2010. Between that time period, the investment banks merged together, right? Or they bought out each other, or they, somehow there was only 5 left, or 5 or 6, whatever that number is. Don't quote me on it. But it was a handful. And so what did that mean? It means that how many traders do you have at a investment bank? The one that I used to work for, I can't remember how many there were because I only worked in one building, and there were, San Francisco, many, New York, Chicago, all over the world. But, when you have one company managing assets, it's just not good. It's watered down. And so, think about when a company is created. So I'm going to talk about the turn of the century. And the turn of the century, there was a car manufacturer. The car manufacturer he basically started from scratch. And back in those days, they became who they were, famous based on what kind of race car they were able to create. And so this was one or two guys that put a race car together, which was nothing special, and they started racing. And so once you start winning races in Europe back then, you become a name, and then everybody wants to hire you to create a race car. So that's how Ferrari, that's how Bugatti was created, Rolls-Royce, Rolls and Royce, two separate people. And once you start becoming very famous, you could start selling your race cars to the royalty and rich people. And so Bugatti, one of the most expensive cars, the Bugatti Royale, that was enormous car. It was one of the longest cars. When the owner of that company was still alive, like Rolls and Royce, for Rolls-Royce, the mechanics that went into that Rolls-Royce or Bugatti or Ferrari or Lamborghini, whatever the car company is, when the owners were around, they were doing the best that they could, that they knew how. And they weren't afraid to change stuff, to make the engine faster or to change, hydraulics, whatever it was. But once they died and management took over on those car companies, there was not much innovation that continued. So in the investment bank world, that happened as well. I don't want to say the names of the companies because, I can't talk about that. But, for example, the guy who funded the Titanic and that company, if you know the story, you know who I'm talking about, which investment bank today that's still around. And so when he was around at the company, he was pushing the company exactly where he wanted it to push it. But once he died and management took over, that company didn't really become innovative, just like today. They're just surviving. There's just a bunch of directors managing situations that happen in the company for day to day. And yes, they meet with the chief financial officer and chief ECO and board members to have a direction of where they think that the company should be going based on the markets. But again, if you're an employee at a company, you're afraid to change stuff. You're afraid to have too much innovation because you don't want to take a chance because you're not an entrepreneur. That's just a fact. People who are directors, managers, they have an incredible short-term memory. Their long-term memory may not be as strong and their visualization may not be as strong. Whereas entrepreneurs, people who go out on their own and create something from scratch, those are people who have very good long-term and visualization abilities. They may not be able to sit in a meeting and sound polished, but they could certainly create innovation, just like the car company that's electric today. He's doing everything from scratch. Everything he does is perfection. And so that's why, as I'm giving you examples as to why a hedge fund manager is so innovative, that they're perfecting their trading strategy, their risk management strategy, whatever you want to call it, to the best possible ability. And when they're small, that's another reason that they're able to do what they need to do. And the larger hedge funds out there, now they have traders trading for them. And again, the cycle repeats. Those traders are not entrepreneurs. They're not going to change what they need to change. They're afraid to change it because they want to make money and continue to have a paycheck every week. So there's a major difference between people who work for a salary and commission. They're used to getting paid and they're content with that. But people who are entrepreneurs, they're not content with that. They don't like that. They want the ability to make millions. That's what a hedge fund manager is. And that's why they need to be smaller, under 350 million. It depends the strategy that they're using. Okay, not all strategies are affected. For example, some strategies need a lot of money to trade and some don't. Some markets are very liquid. What is liquid? Well, if you don't know what liquidity is, meaning that there's a lot of, so in Europe you have Piazza, which is the center of the town. Like in Milan, you have the Duomo. There's thousands of people standing around the Duomo all day long, talking, meeting. You know, when you go to Milan, you go to the Duomo, the center. So that's like the stock exchange. You know, there was a lot of people back then, 50 years ago, 30 years ago, when they used to use paper. And so there's a lot of action for that particular underlying asset. And so when there's a lot of people going back and forth, a lot of trading, a lot of movement, that's liquidity. And so that depends on the strategy. So another reason is liquidity, as I have mentioned. Now, in my case, when I was trading options, etc., I didn't watch the news when I was trading. That's actually called static, and you don't want that. I mean, it depends your strategy, depends the news that you're dealing with. But so my strategy, only doing one or two indices, I couldn't manage billions of dollars with that type of strategy. So when you talk about, does a hedge fund, a smaller hedge fund, a maximum amount of AUM, and it's going to affect their returns, that's also the issue, is the underlying assets. So once the portfolio of the hedge fund manager becomes too big, we're only human. And when you're human, you could only handle a certain amount. So it depends on the strategy, the markets that he's trading, and her. That also plays a role in their returns. The hedge fund industry has become what it is today because they don't have anyone that they have to report to. They have their clients to report to, and so if they don't do the proper job, are they going to have clients? No. So they're not going to just lose your money, right? I mean, they're sophisticated people. They know what they're doing. They have a track record, and so that's all false. What the media says is they're doing bad stuff and they're going to explode. No, it's not true at all. And so for me, going through thousands of long or short equity hedge funds and reviewing them and seeing how they perform in the different markets, that took a lot of work. But they each have a certain blueprint based on the markets. And that's what I kind of call it, a blueprint. And so that's, something that you have to think about is what the strategy is in the markets and all of it. It just depends. And so to recap, the size of the hedge fund affects their returns depending on what market they're trading. If it's highly liquid, then it shouldn't affect them. But of course, if it's 2-3 billion, of course it's going to affect them because that trader has to manage so many different trades, and in order to keep those trades smaller, they have to manage it, and that takes a lot of work. So it's better to go with the smaller traders than the larger ones. And just because a large hedge fund has billions of AUM, it doesn't mean that they're so sophisticated and they're going to be around forever. No, they're just very lucky to have really good contacts at the investment banks and at the endowments, etc., who they're able to raise capital from, to find investors. And the smaller hedge funds, they have to do a really good job to keep raising capital, so they're going to do a perfect job. Think of something that you make, like, I'll use jewelry for an example. If you're creating a portfolio of diamonds, you are looking for the best diamonds to create in your portfolio, right? And you're constructing it. Well, that's what a hedge fund manager does. That person is trying to create the best returns, and they're going to be very, very cautious on what they do so that their returns are the best. And so as a funds of funds analyst, a portfolio of hedge funds or a FOF, whatever you want to call it, that's basically you're looking for those golden eggs. And that's basically what my video is about, and I want to thank you so much for watching. Please remember to subscribe so you get my future videos, and also remember to thumbs up so that it gets the algorithm working so other people will see my videos. And then of course, share my video with at least 5 people. I would really appreciate that. And lastly, send me a question or a few questions or as many questions you want to live chat, and I'll create future videos just for you. Thank you so much for watching.